Hello.
Hey,
We're back. With Macro Tuesday. And we're going to be talking about Japan. And
Japan and things, and
actually,
just
why
it's
don't you do
how
the intro? You're
well
the man of the day. So go ahead,
the
please,
man of
and
the day.
do the
Fair.
intro.
Yeah, no, today. So there was a Twitter thread that I shared a few days ago in the Discord. It sparked a bit of conversation, and people were asking asking some questions about it, and I thought I'd kind of expand on it a bit more because it's something that a lot of people don't understand because our media, everything that you watch is so US centric. All you hear about is the US economy. What is the US Fed doing? What is Biden doing? How is he destroying the economy? How is Trump destroying the economy? But what they don't seem to realize is there's like this whole planet, and the US is like a quarter of it economically. It's a huge part, but there's a whole like 75% of it, and that 75% of it has to slot into the US model because the US is the largest and because the US has the global reserve currency.
Yeah.
And so that is why Jerome Powell, for as much as he gets rightfully bashed when he says and does stupid things, he has an incredibly difficult job because he isn't just the central bank to the USA. He is the central bank to the world. He's the head of the central bank to the world. And what I mean by that is every other country does business in US dollars. So US monetary policy affects them. It affects the trade that they do in US dollars. So realistically, he has to consider what the effect on his essentially subjects are, the subject nations who have very little control over their monetary policy, because the US by its nature is the most trustworthy currency. People will talk about the fail of the dollar, especially in Bitcoin circles, but please don't get confused. The dollar is king. The dollar is absolutely king. And yes, it is, I wouldn't even say under threat, but there's things like the sanctions on Russia, meaning that China are now doing their trade for oil with Russia in yuan. And yuan is virtually useless on a global stage, but China are trying to change that. Well, they tried to change that with the Belt and Road Initiative and issue an absolute ton of debt to other countries. And now they realize that all these other countries can't pay it back. Why can't they pay it back? Because the currency is so weak, because the dollar is strengthening in global terms. And this is the confusion everybody has, is the dollar might be weakening against itself, against the global macro economy, but against the other currencies, it is strengthening. In crypto analogies, the dollar is Bitcoin. What happens in a bear market? Bitcoin gains dominance. All the weaker currencies flee. They don't have liquidity. They don't have buyers for them. So the people who sell those currencies go into the safer currency, which is Bitcoin. And that is no different on a macro scale. If the dollar is strong, by definition, every currency that values itself against the dollar is weak.
Yep.
So we have to consider that if the US are trying to target 5% interest rates, then what do you need as an interest rate in order to keep your money and invest in other countries? Because that's what you're basically doing when you're buying a government bond, is you're investing in the economic prosperity of the country. You're saying, I trust you to pay me back the amount I'm giving you in the time period I'm giving you for the interest rate provided. So if you're a less trustworthy country, you have to offer higher and higher interest rates in order to satisfy the demand for that debt. People are going to say, I don't trust your debt, I don't want to buy it. Okay, but you're giving me 8-9% rather than 5%. Yep, I'll take that for the additional yield. And it leads to quite ridiculous things like Sri Lanka which I'm sure it's much, much higher now. But the last I saw, the interest on their government bonds was around 24%. So at that point, if you're doing any business in Sri Lankan rupees, what business can you set up that is going to guarantee you, with no further thought, no effort, no risk, is going to guarantee you 24% a year? None. You can't do that. There's very, very few businesses that do that. So why does anybody who has money in that country, why would they invest in the country? They wouldn't. There's no motivation to invest in that country, and the country enters a death spiral. And that's exactly what happened to Sri Lanka, where it completely ran out of foreign reserves during COVID, where that they have a few major industries: tourism, food, and basically textiles, clothes, making low value sort of goods. And COVID ruined all of those. So Sri Lanka is a good segue into Japan, the bigger ways, because they had very few parts to their economy, and so they lost tourism immediately. The government had previously destroyed the food supply by forcing everybody to go organic, which basically destroyed the yield that they had. And working from home, things like that. Well, Sri Lankans probably didn't have much protection against worker protection, but for sure it stunted their economy. And so you have so much of their economy suddenly collapsed, and so they suddenly had to start spending their foreign reserves on food, oil, just to keep the economy functioning, and they ran out of money, and the Sri Lankan government basically went bankrupt. And so that's a developing nation. It's a nation that's weak, that's vulnerable to shocks like that. So maybe if you're just gonna put my screen up,
if you ask nicely, yes,
please. So going into Japan has a lot of debt, a lot, 216%, I believe, of GDP, and this is something that's been growing from 40% of GDP in the 1990s. And the reason why it's worth noting is because, as we like to really kind of reiterate on this channel, the bond market is everything. Debt is everything. The way that currencies are valued is built around the bond market. It's built around how much yield can you get for borrowing dollars, which is the gold standard of monetary investment. So it's something to pay attention to, because stocks are priced based on what the bond yield is. Crypto is based on what the bond yield is, because as these change, that's what dictates how much liquidity is available in the market. So if we take a look at Japan's bond situation, I'll go back, let's see, put it on the weekly. It's a bit ugly in that.
Yeah.
So Japan's interest rate, this is the 10-year bond yield, which we like to put it for the US. And in Japan, in here where this chart starts in 2008, I don't know why it doesn't go back longer, actually.
Well, first of all, what are all the different lines? Let's start with that.
I was trying to get there, but I thought this one was... Let's try the 30, see if it's longer. No, it's not. Oh, that's disappointing. Okay, anyway. It's been heading down.
Yes.
So the orange line is the Japanese Bank of Japan, the Japanese central bank. That is their federal funds rate, essentially. That is their interest rate.
Right.
And it is small. It is really, really small. So you're talking 2% was the target rate coming out of 2008, and they very quickly realized, okay, this isn't sustainable, mainly because we take a look at the US one over the same period of time, because the US dropped theirs, and so that gave the Japanese room to follow.
Right.
The Japanese have a lot more debt, so if the US have dropped their interest rate to near zero, well, the Japanese can do it as well, and that means that it rapidly cuts their interest rate. Now, the problem that Japan have is they are old. They are very, very old. They are the oldest country on the planet. And so there is a saying that we are all Japan. Every country is building towards a Japan-style economy, and therefore we can look at Japan and we can learn the lessons, what they've done right, what they've done wrong, and we can use it as a predictor for where we're going.
Yeah.
And so Japan they dropped their interest rates. They went all the way down to negative minus 0.3% interest rate.
That's insane.
It is. And
what does that actually mean? Just for the people watching, just explain that to them.
What that means is if I borrow 1 million yen off you, in a year's time, that will be worth 999,700 yen. That would be the debt if I didn't pay anything off.
Yeah.
So every single month, your debt would get slightly smaller, and as you made a repayment, you would pay off some, and your debt would get slightly smaller because of the negative interest rate.
Yeah.
I know there was a period in COVID where Denmark briefly offered negative interest rate mortgages, so they would pay you to buy a house. Ultimately.
Yeah, that's insane.
And yeah, it is. It really is insane. But the reason being is because Japan's demographics couldn't handle this, and we've touched on demographics so many times. Yeah. I'll push onto that specifically a bit more later. But for now, just bear with me. It's because of demographics. Now, that demographic shift hasn't changed, but something has. That interest rate, which has been pushed down year after year after year by Japanese people retiring and not being replaced in the workforce, that trend hasn't changed. But the bond yield has. The bond yield has now started climbing rapidly. And the reason for that, quite simply, if we just put this back up again. What did the US do? They started jacking interest rates up. And so the interest rate, which had been hovering around zero, I know this looks like, it had been heading upwards since 2020 or 2019, but this is zero. So, let's not don't go thinking that this is a bullish chart at this point.
Can you put a line on zero, just so it's more visible? I think that'll help. So there we go. Yep. There we go. Yeah. That seems right about. Yeah.
So if you think going to 0.87% from 0%, that is an infinity percent gain in interest rate.
Right.
Yeah. And Japan can't necessarily handle this. And because you can go and get 5%, or what they have here, 5.33% is the US federal funds rate. Mm-hmm. And Japan's is 0.1. They've just raised it for the first time in, when was it? 2007 was the last time they raised it. So 17 years since they last raised interest rates, and they raised it from negative 0.3 to 0.1 over the last couple of months. So, it's not bullish for that.
Not really, no.
If that's the case, if you can get 5% on US government debt, why would you buy Japanese debt and get 0.87%? Why would you do that? What you wouldn't. And so people aren't. And what that means is if you go to and let's just swap this for JPY USD. It means this happens. It means the yen has lost 35% since December 2020.
Yeah, it's quite bad.
It is quite bad.
How much is it? 35%?
35% drop, whilst at the same time...
Aggregated inflation, right?
Yeah. Whilst at the same time, the debt has gone from 236... is it 230... Was it Ministry of Finance? Is that 236 trillion yen to 263? So they've tacked on an additional 10% of debt, whilst their currency is sliding, and their debt pays no interest. So
Yeah.
the reason the currency has dropped is because there is no demand for this debt. So the way that they've been dealing with this debt is by selling US assets, US treasuries. Now, this looks really bleak for Japan. Let's not think that, so you think, oh my God, Japan's in this horrible, dire death loop spiral. Not quite, because Japan has a little bit of a trick up its sleeve. They're not stupid, and it's a real mistake to think that central banks are stupid, and the Bitcoin media will have you believe that they're all complete morons in the Fed. I promise you they're not. I promise you that they're looking at things you're not looking at. And yes, they lie. I'll absolutely tell you they lie, but they're not morons. And so what the Japanese have done is, for the last few decades, is they've been buying assets. So as they have depreciated their currency, as they've had this issue where they've had to monetize all of their debt and just balloon the debt, they've taken this debt and they've actually purchased basically stocks, Japanese stocks, to the point where Japan are now by far the largest single holder of Japanese equities. That's what they do. So they essentially print money, they take on debt at incredibly low interest rates, and they use it to buy assets. And assets have done quite well. The Japanese stock market hasn't done very well, but if you look at this chart, which is the central bank assets to compared to GDP for Japan, they have 92% of their GDP in assets.
Wow.
Yeah. So this is always the question, and it's the same sort of question that I mentioned about, like, when people talk about Michael Saylor, when his position fell into a loss, and everyone's saying, "Oh my God, he's going to get liquidated." As long as you can service the debt, if your assets are trustworthy, and if your assets are sat there and people looking at it going, okay, yeah, they're in a loss, but they're solvent because those assets are bearing yield. These aren't useless assets. These are productive assets. These are a huge chunk of Japan's economy. And yes, it's a certain, there's always the argument of, oh, this is governments controlling companies, this is socialism, this is that, this is this. I look at it as, well, should a government not own a stake of the most productive assets in that country? I think that's a genius plan, to be honest. I don't think that it should be a blanket purchase, but if I was in charge of Britain's money, I would certainly like to see that we were investing heavily in the most productive British companies. And we actually Britain does, and that's why, as much as people can protest all they like, we're not going to stop selling weapons to countries that we don't like, because it's our chief export. It's the one thing that we're really good at, and you leverage what you do. And the British government has invested tens, hundreds of billions in that strategic resource. Japan are doing the same thing. So where it comes into a problem is that, because of this currency collapse, Japan have to do something about this currency collapse. They can't just go, oh shit, let's just let our currency drop. And so what they have ended up doing, if I just go to, here we go. So this is a article from Reuters a few days ago. And if Japan exhausts the intervention slush fund, treasuries may wobble. So essentially what we had...
It's a funny sounding title, I'm not going to lie.
It is a funny sounding title. Those are funny words. If I just remove the other indicators...
That's not really what I meant with that, but sure.
Yeah. So basically what's happened here in the last few days, let's just zoom right in. Oh, look at that spiky chart. That looks like a really natural set of price action, doesn't it? And when you compare normal price action to this, I think it's pretty clear something went wrong. And we can actually zoom in all the way to the minute chart here. See, I would,
Is it high kinetic candles?
They look like it, but this isn't like a close. These are minute candles on a major currency pair going up 2.86% in less than an hour.
Yeah,
that is a major intervention. And what that intervention was, it was Japan selling around 35 billion of US treasuries.
Right.
And they're doing this to prop up their currency, because if your currency is in free fall and you've got assets, you need to sell some assets to protect your stuff. And what we're seeing so far is, it's pumped up a bit. It's not helped though.
Yeah.
And so I don't want to say that Japan is suddenly facing a crisis. It wouldn't necessarily be true. However, it kind of looks a bit like a crisis, because
Yeah. It's not looking great.
If I'm looking at this on a technical chart,
oh, yeah, I saw that.
Yeah, and that's what 35 billion of intervention did. So just for comparison, I mentioned it a couple of weeks ago that the UK government, when Liz Truss came into power, and she announced a 40 billion pound unfunded budget, basically, and the UK bond market completely shit itself, and the Bank of England had to do 65 billion pounds of quantitative easing to stop the entire pension system from collapsing.
Right.
So for a 40 billion pound budget, they had to do 65 billion of QE.
Talk about going the wrong way.
They literally could have just printed the money and given it to them and done it. Like, that would have been more fucking productive than what actually happened.
Because they
Yeah.
So 65 minus 40, right? All that's just fizzled out.
Yes. So essentially just 25 billion poof. Well, no, 65 billion poof, because the budget never even got fucking spent. So, so yes, it was. And
that spiked the CPI as well, right? Must have shown a little bit.
I'm not sure. Yeah, I don't.
Maybe not.
Who gives a shit? We're ruined anyway. But basically, what you're now seeing is you're kind of seeing the same thing in the Japanese market.
Mm-hmm. Yeah.
And we've seen it, and so where this ties back in is we saw it happen in developing nations during COVID. Really weak nations that didn't have any robustness, didn't have a wide range of industries to fall back on. It's starting to affect countries like Japan.
Yeah.
And Japan is limited in many ways, but it is a giant of an economy. It is not going to disappear. They have a whole host of issues, as mentioned, with demographics, but it's a global shit show. And it's the reason it's happening is because of US interest rates. And as much as the US bond yields are going up, which is going to dictate Fed policy to go take yields higher, the rest of the market is screaming, we need lower yields.
Yep.
And the global market is telling that. And if we can have a look at the euro versus the dollar.
So I want to tie a question into this, I think, if that's all right, because we got one from Yakan, and he asks, can other countries be in trouble if the Japanese yen is in trouble? Like, what's the
economic
domino effect of that sort of?
So the domino effect. So the domino effect is, as I said, that Japan are having to dump US treasuries in order to protect their currencies. So that pushes down the US bond price. And in turn, what does that do to the bond yield? It contributes to pushing the bond yield up. So this is where so the US has a real problem whereby the bond market is saying we need higher and higher interest rates. Meanwhile, the rest of the global market is saying we need lower and lower interest rates. And what's going to happen is if we don't lower the interest rates, they're going to keep dumping bonds because they have to, because they need liquidity. And this is the question of where there is no liquidity in the market. It's like just turned up that we've finally stopped being in a negative liquidity scenario for the first time since 2020. That's not the same as a 2020 COVID glut of money entering the economy. It's not the same. Economic conditions are still a lot tighter than they were in 2021, and yet stock market, crypto, a lot of markets are at all-time high, and all it takes is for something to break, and those markets are not going to stay up around all-time high for very long. And this is the sort of thing that breaks economies. So but ultimately what the big perspective is, that while interest rates are so high, foreign countries are going to dump US treasuries. That is going to push up US bond yields. The US don't want higher yields, they want lower yields. How do they get lower yields? They lower interest rates, stop countries dumping the bonds. So ironically, if the US Fed, they just lower the interest rates and the bond market will follow. That's what it's supposed to do. That's why they set the federal funds rate the way they do. So yes, all this is saying that interest rates cannot stay this high for long without causing a major crash. That's the takeaway, and this is something we've talked about all year. And what was the average?
More than a year.
Yeah, 11 months is the average time that they pause rates.
Allow me, I actually have the chart here.
Yeah, you have the chart up.
I can bring it up. Give me just a second.
And so this is why these things don't happen overnight. These are long, slow-moving global trends. But what is clear from this overall scenario is that this chart right here, the US putting up the interest rates the way that they have, this places an extreme amount of pressure on the global financial system, more than it did back in 2008, because the debt scenario is much worse. Mm-hmm. And it's bad. It's worse for the USA as well. And so the whole thing is they're going like there is no like it's completely illogical that interest rates stay this high on the global picture. However, the inflation side, which is driven by a whole bunch of macro uncertainty and just the world falling apart in various different ways, that's not going to get any better. So this is why the Fed are fucked. Yes. They're screwed. They have no out. They don't have a solution.
They have to pick the least damaging one, essentially.
Yeah.
And I would assume that is printing more money and lowering interest rates.
Yeah.
They have to do it. That's what the entire system's built on.
Yes. It's stagflation, one way or another.
Yeah, we are there now, by the way. I was going to say.
Where essentially you have this period whereby we don't get richer, we get poorer, while we're in so basically we're in an inflationary environment where things keep going up in price, but the economy just cannot keep up with it. Exactly. And there isn't going to be the capacity in the market to hold interest rates higher. So as we drop interest rates, inevitably, then what that's going to do is drive assets higher. It's going to prop up the asset market. Yeah. And they're doing this that's a nice little segue into the last little bit. I'll just actually come back onto this article for Japan.
Yeah.
So just to show the extent of this is. So Japan, estimates suggest Japan have up to $155 billion in deposits. Just to say, estimates suggest Japan could have. Nobody knows. Absolute gold star, the best possible investment in the fiat world that you can. And they maybe have $155 billion. Meanwhile, we can tell them exactly how much to the Satoshi, how many Bitcoin the Japanese government has.
Yeah.
So, hang on, isn't it a bit of a red flag when you're looking at a crypto project if you don't know how the supply is?
Yeah, I would say so.
Supply, yeah.
Yeah, self-reported circulating supply, everybody. If you find a project that has that on their whatever page, what's the website's name? CoinMarketCap. Damn, it completely fell out of my head. Yes, If you find a project there that says self-reported circulating supply, red flag.
Yep. And
So
but ultimately this is just dollars. This is Japan's war chest, 155 billion, and that's what they can use at any time to prop up their currency. And so it said Japan, they spent 35 billion on Monday, and they've spent 60 billion between September and October. So yes, this fund will be replenished because Japan are one of the largest holders of US treasuries, meaning they're getting paid right now over $1 trillion of debt. They're getting paid 5%. So the US government is handing them $50 billion a year. So that replenishes this war chest, and that's what Japan will use to prop their currency up.
Yep.
But they spent 35 billion and it just didn't do anything. And so
it blipped, basically.
Yes, and this is the problem where you have the capacity for governments to maintain this system is starting to break. And it all stems because the trust in the US debt is failing. And at 5%, people are looking at it going, do I actually want to own US bonds at 5%? But if I don't want to own US bonds at 5%, I certainly don't want to own Japanese ones at 0.8%. And it goes all the way down. The risk curve always has to go down. So, yeah, they currently have 1.16 trillion of securities, of US securities. And that's something that's been going up and up and up. Because Japan, like I say, they're not stupid. They've been buying US currency for decades because they know that they can then use it to prop up their own currency. They're just pseudo-backing the yen.
It sounds like instead of using gold or Bitcoin to prop up their currency, they're using the US dollar.
Which, unlike gold, the dollar pays interest.
Right.
So if the interest rate... So think of the game that Japan are playing. Japan can hold 0% interest rates because if the yen is 5% safer than the dollar, then you'll sacrifice the 5% interest rate. Yeah. For if the dollar is devaluing by 5% and the yen is not, because they're propping up its value in real terms by trashing the dollar by selling bonds, well then the yen will maintain its value, the dollar value goes down, and so even though you're being paid 5% on US bonds, you'd still rather own the Japanese one.
Mm-hmm.
Yeah, so it's a very awkward game. These are currency games. Oil comes in here as well. I'm not even going to get onto oil, but oil is essentially oil plays a big factor, and this was something we talked about in the Discord, where Japan are a huge oil importer. They have very few natural resources themselves. So when the price of oil goes up, they have to spend a larger percentage of their currency, their global GDP, importing energy. So China are exactly the same, and as I say, with the article shared, it discussed both Japan and China, but China are incredibly energy hungry as well, and so yeah, you have a problem where they're very weak to oil, and they will often sell off the treasury bonds in order to buy energy. So yeah, there's the chart you saw before. Very violent move as they did some intervention, and
Great.
Yeah, so Japan, they're still the largest foreign holder of treasuries, but they once owned 18.2% of all treasuries, and they now hold 4%. So that tells you one thing. One, Japan owned an insane amount of US debt, and two, despite Japan increasing their amount of US debt, the amount of US debt that's been issued was so absurdly large that their holdings of more than
let's look at that chart there.
Yeah.
You can see. Oh, hello.
Yeah. So
that's a downtrend for sure.
Yeah, and this is, and this is kind of, I don't even know where to start and what this tells us, but it's not great.
Yeah.
And yeah, foreign central banks overall only account for 14%, having been 40% before the global financial crisis. So that you can see right there, 2008 was a step change It was
Yeah.
a fundamental change in the way that the world saw debt. What happened there? What happened in 2008 for the first time?
Mm-hmm.
The US started printing money out of thin fucking air.
Yep.
Here is the chart that tells you the trust that foreign central banks place in the US dollar. Yes, it's diminishing, but it only diminishes as long as your own currency holds any value. Unless your own currency is crashing, in which case, even if you don't want to sell the treasuries, you're forced to sell the treasuries.
Yep.
You see how this is just one big, massive clusterfuck, and why we don't have enough Bitcoin.
Yes. And I was just going to get to that, if you don't mind, just real quick.
Of course,
because
of course.
I've been very quiet today, which has been nice. but I found this thing, I've seen this before, but so Japan is actually pushing lots of money into Bitcoin for pension funds. Currently, they're testing it out. Let's see. I think here's the assets under management. That's 225 trillion yen, and they've put in about 1.54 trillion into Bitcoin in that pension fund, as far as I can tell from this. And that was fairly recently as well. And so they're starting to look at alternatives to hold assets that can prop up at least the pension side, it seems. I think that pension fund kind of realized that it needs to hold something scarce that you just can't just snap your fingers and get more of, right?
Yeah.
And there we go. There's the argument for Bitcoin as well.
There's the argument. So yeah, it's a good it's a good argument. Thank you for that. So I'll just round this off. So basically, what does this mean? Because we talked about Japan and mentioned, yes, we don't look enough outside the US, but realistically, coming back full circle, the US is the most important economy. It's the largest economy. It's a driver of what happens, and so we have to consider what is going to happen to the world's economy. And so I'll go to one of our favorite fellows, Raul Pal. This is something he posted all the way back in 2022, but it's so big picture that it's still perfectly relevant. And it came after COVID to the point where we can see what happens. And welcome to demand destruction. This was right in the middle of the bear market. And I'm not going to go through and just read all this, but I've put this on because it has quite a good few charts that we like to share. And it, as I said before, we are all Japan. We're all heading the same path of Japan, in that our workforce is getting older, our birth rates have dropped, and the workers who are retiring from the boomer generation are not being replaced on a like-for-like level. And because of that, we have a large retired population being supported by a very small working age population. And as much as advanced nations can handle that a certain level, because of obviously automation and the fact that they're at the cutting edge of what's going to be available in terms of replacing that manpower. And that's all automation is. Automation is just capital. It's just stuff. You still need labor to use the capital. So if you can create capital that's 10 times more productive, then you're not going to need 10 times less labor. That labor is just going to get more productive. It's still a problem because either way you slice it, the tax revenue or the money, one way or another, has to be found to pay for these old people, and it has to come out of working age people. The automation doesn't come into it unless the robots are going to start paying taxes. So there's your argument for companies that use an argument. Yeah, there's an argument for companies that use a huge amount of automation, that they should pay more corporate tax because we get less income tax from them. There's the kind of arguments you have to have. So the US being the most advanced nation can offset this. This isn't we're going to go into a 20-year period of recession with negative GDP growth. No, we have advancements. We're advancing a huge amount as a society. This doesn't mean negative GDP growth forever. What it does mean is stagnation. It means the world getting 5% more efficient, but us still standing still. It means an increase to the debt burden, even though we're supposedly getting richer. It's just an unhealthy situation overall. And we can see where this problem started. The mid to late 90s, this is where the first of these people started to retire. And essentially, when was this? These were the oldest of the boomers. 1945 to 1997, that put them at 52 years old. So yes, people born into the war, after the war, yeah, they hit their peak earning, started to trail off, and since then you've seen a collapse in the velocity of money. And the velocity of money is basically how much of the money supply is circulating around the economy. And so a value up of 2.2 basically means each dollar is spent 2.2 times of the GDP.
Yep.
So we see that dropping, and the reason for that is as these boomers have aged into their peak years, starting at 1997, roughly, as they hit 50, 55, they hit their peak earnings, they paid off their house, their 30-year mortgage that they got when they were in their early to mid-20s, or 25-year mortgage. They've paid off their car, they've bought all the stuff that they need in the house. So they start putting their money into investments. Heavily. Really, really heavily. And that means they stop spending their money.
Yep.
And so that was 1997. And what happened towards the end of the 90s? Can anyone remember a certain...
No one is going to answer, right?
Yeah. No. Well, yeah, we got the tech bubble in the late 90s, and part of that is a lot of people suddenly getting rich all at once, or not getting rich, but suddenly having spare money and going, ooh, shiny stonks. And that's been a trend that's carried on for the last 25 years, 30 years.
Yep.
And it's going to carry on as this generation continues to retire. So yeah, the bigger issue is demand. It's the demand for money. So that's the velocity of money versus the labor force participation rate. How much of the workers are in the working? How many of the population are in the labor force? It's a 1-for-1 match. Within the data collecting abilities of a nation, that is an utterly astounding trend.
Yep.
And what we're seeing right now is quite a bit of deviation from that trend in 2022. I don't have the updated version of this chart, but trust me,
it's fine.
Trust me though, this will mean revert, and we know where the trajectory is going. So, labor force participation rate, GMI composite, that's the predicted rate. COVID has caused a spike upwards, a deviation of this spike, whereby the labor force's participation rate has actually gone up. We're still in a generations-long downtrend, so yes, this is a discrepancy, largely coming because an awful lot of people over the last few years have hoped to retire and found they don't have the money to. So we're actually seeing a reversal whereby people are staying in the labor force longer through necessity, and that has helped to offset this somewhat, but overall the trajectory is still clear, and that's the mean reversion will occur over time, and this will carry on going down. And yeah, that means the velocity of money is going to continue to fall, and more percentage of the money is just going to get stuck in assets, and a smaller amount of money is going to be actually available to grow the economy, invest in the economy, and get out of this slump that we're in. So what happens to inflation? So demographics will continue to apply. downward pressure once the supply shock has worked its way through the system. And there's the caveat. Will that supply shock work its way through the system? You better hope China doesn't collapse, because otherwise we need to find several tens of $1 trillion worth of equipment investment. You better not hope that the Eurozone doesn't have a crisis. You better hope that, I don't know, Texas doesn't secede. It doesn't matter what the crisis is, there will be a crisis at some point. And if that is, as it probably is, highly likely to be inflationary, you've got a trajectory which is, this is US birth as a percentage of total population leading 30 years. We know this trajectory for the next 3 decades, and it is down hard. And this is the US, who has a very good demographic profile for advanced nations, by the way. Do this in Germany, oh dear. Germany are in a world of pain. Do it in South Korea are terminal. You do it in Japan are pretty close to terminal, because this problem isn't going away. So the world is deflationary. These inflation spikes are, as Jay Powell said, transitory. The problem is transitory can end up being 10 to 20 years if the world decides it wants a really good long war. So we'll see how that goes.
Yeah.
Wages, okay, yeah, that's a bit spiky, but real hourly earnings, where's the average? For the last 45 years, 0.19%.
Wow.
That's the average. That's the real pay rises. That's the real terms pay rises. So much for all of this technology making us richer. So much for all of this development. All it's done is given us very nice, cheap trinkets. Meanwhile, nobody can afford to eat. So what do people do with zero wage growth and rising asset prices? They go into debt.
Yes.
There's the
just
US
just a tad.
So that is 90,000. So that's $90 trillion. That is the total US debt. That doesn't include, I'll tell you straight up, that does not include the unfunded liabilities. And this is actually
big chunk.
US debt clock. Let's get on the US debt clock.
Yeah,
a while since I saw this. It now stands at 34.7 trillion. The last time I saw this, there was a 2 on that number.
Yeah, same.
Yeah. So that is $103,000 per citizen. So congratulations, if you're in America, you are $100,000 in debt.
On average.
As a citizen of the USA, if the citizens are responsible for the debt of the government or of the country, yep. One way or another, if this debt is to be repaid, it has to be repaid by the citizens. So yeah.
Yeah, and the funny thing is that even if people took all the money in circulation and paid the debt, it wouldn't pay the debt off.
Mm-hmm.
It's like, how does that even?
Now,
there's this really, I'm just gonna say, there's this really fun old documentary type movie. It's a lot of propaganda and everything, but they have one thing that they said that really stuck with me when I was a kid. It was that the US is borrowing money from a private entity, which is the Fed, at interest, but that money is created out of thin air, essentially, which means that if you borrow $10, you owe $12.50, let's say. So even if you pay back the $10 with the money that they printed, or if you take all the money that they've ever printed and pay the debt off, or pay what you owe back, the interest on that is still going to have to be repaid with money that doesn't exist.
Yes.
So
now
that's hilarious.
It is.
In a really not funny way.
It is. Now
it's just ridiculous.
So there is a caveat to that, though, and we talked about what the assets were, and obviously the US, Japan have 90% of GDP just as assets themselves. Now, this I'm going to take these numbers as they're worth, but these are private assets, not government assets. But let's remember, the US is a country that prides private property ownership above all else, more than pretty much any country in the world. So Japan doesn't have that same culture, and so the idea of a government holding assets versus the people holding assets, either way you can see them as the nation holding assets. And so even though there is a debt per citizen and a debt per taxpayer of 266,000, but a debt per citizen of 103, the assets per citizen come in at 600,000. So the US is not illiquid, but it is because it can't stop fucking spending money like a heroin addicted crack whore.
Yes,
that is it. This is it. The US government is absolutely smacked out on free money, and it cannot kick the habit. And yeah, the current interest on debt stands at $822 billion per year. War, $886 billion. So they're approaching the same number. 1.4 trillion on Social Security, 1.7 trillion on Medicaid. So the interest is half of the goddamn medical budget. That's the problem. The problem is not actually the debt, because as you see, the assets, if you look at the total assets, 605,000, but so that seems okay. But then let's reverse it, and then let's look at what are called unfunded liabilities, and those are these ones at the bottom right hand here. And these, so the total Medicare budget, 1.7 trillion a year. The Medicare liability, which is money that has been promised to be paid out in the future, is 41 trillion. The Social Security money that has been promised to be paid out in future, 26 trillion. The total US unfunded liabilities, this is things that the US has promised that it must pay out. Pensions, so a huge one of these are state pensions for state workers. A lot of states are effectively bankrupt. The cities that have given out generous pensions to boomers for decades are now completely unable to pay what they promised, and they're in debt. Those go down as unfunded liabilities. So the US, that is already running a deficit, cannot afford to pay this money on top of the money it can't pay at a state level, at a federal level. It can't. So the US is just completely overspending, and that is where the problem comes in. Now, there's a very, very easy way to save $800 billion a year, and that's to slash the interest rates. The overall global economy is screaming for lower interest rates. The demographic profile is screaming for lower interest rates. The inflationary environment is coming from global uncertainty, because it sure as hell isn't inflationary apart from that. So, just to round off, we're screwed.
Yeah.
Because the debts are going up for the people who are accumulating debts, i.e. the millennials, the younger generations. All of the asset holders are now retiring, and they need to sell their assets off. Japan have been doing this to people who do not have the money. They physically do not have the money to buy them. And there are too few of these people. There are too few of us. How did Japan get around this? Japan stepped in and bought the assets directly themselves.
Yep.
We are all Japan.
Yeah.
This is the invert of the Fed balance sheet. So this Fed balance sheet, which is flipped upside down. COVID caused a big glut. Basically, COVID sped the process up, and it also retired a few people. A lot of people, kind of died. It messed things around a little bit with the statistics, and so that's going to take a few years to get out. But the composite participation rate projection is down, and it goes a long way down for the next 20 years or so.
Yeah.
So that's the overall story of what I wanted to kind of talk about. I realized that was a big brain dump that I tried to keep somewhat structured. I hope it
what the
wasn't
thing is?
too roundabout.
I don't think it's the good thing about this stuff is that this type of thing that we talked about today, or well, that you talked about and I listened. I mean, obviously we have these conversations all the time. It's just your way of being able to get through this type of stuff is much better. So just shut up. But this type of content that we're doing right here, it's probably not going to be very popular amongst people because people don't want to learn this on a like a large scale. A lot of people don't want to learn this type of stuff, and they think they don't understand it. But for the ones that do sit here and listen to this stuff, I am gonna be surprised. Like if you're not shitting your pants in one way or the other when you're listening to this, that means that you're either not really understanding what's going on, or number two, you feel safe because you bought Bitcoin.
Yeah, I mean,
essentially,
that's yes, and
that's very simplified, but obviously,
and this is, I mean, this is ultimately there's a kind of, this is a doom scenario, but within every doom scenario there are opportunities.
Yep.
And what you have to look at is the reality, whether or not you like it, whether or not it's distasteful. You have an opportunity during what is going to be the largest transfer of wealth in history to grab more than your fair share of that wealth.
Yeah,
and once it has transferred, this wealth has transferred once, it is never going to transfer again, because I expect, if at least not the Japanese government and the US government, Chinese government, European governments, they're all going to have to do this. Some of them will do it, some of them won't, some will do it to different extents, but the trajectory in every single advanced and developing nation is very clear. So you need to get ahead of it. And if you are switched on, and you know, now is one of those things, like, you don't need to be a millionaire. You don't need to be super rich to make life-changing money investing. But it will take sacrifice. And as much as if people say, oh, well, I want to live in my own house and I want to have a car, it's like, okay, well, yes, great. You're going to have less money for investing. You're going to be working longer. You'll retire later. You'll probably die sooner because your entire life will be less healthy because you didn't put the effort in to make sacrifices early. And if you are young and you do make those sacrifices and you do invest because it is clear they're not going to let the entire global asset market crash.
Yeah, no,
that is it.
Like,
that's obvious. So the world has divested. The world has split into people who invest and people who don't. It's as simple as that. Which one do you want to be?
Yeah, the investor is a pretty good choice. And yeah, I think we're done there. I thought of half a quote from what was that movie called again? The Big Short. If you haven't seen that movie, go see it. It's pretty good. But there's a line there that Brad Pitt gives, and he says, I can't remember exactly what the numbers were, but he said every time you know which one it is.
Every 1% drop in GDP, 40,000 people die.
Yeah. And so if we see a massive crash in GDP, a lot of people are going to die, unfortunately.
People die.
Yeah, people die, but I think the point of that line in that movie was that they were celebrating that they've shorted, and it's going down, and they're super happy. And he's like, "Stop."
Yeah,
think about this.
The world is a finite resource. It's a zero-sum game. If you want to win, someone else has to lose, and well, all you can do is prioritize who wins and who loses by looking after the people you can look after.
Yeah, and we're going to help look after you guys. Yay. The best we can.
Yep.
Yeah. I didn't want to end it on like this sad note, but it is kind of sad. Not gonna lie. It's just the way it is. Anyway, let's round it off here. I gotta get out of here. I'm 15 minutes late already. But I'll be back though. But I'll see everybody in Discord. You know the whole ordeal. Like, share, subscribe, go follow us. And and by the way, we're gonna push a little bit on Twitter now because they've changed the algorithm, and we're gonna start posting some stuff on Twitter for once. So we'll see you there as well. All right. Thanks everybody. Bye.
Bye.